Yeah, let's go. Let's go to the glide path report.
Yeah. So this is a useful review of the key, what it says is the key themes facing CRE capital markets when it comes to macroeconomy, credit, debt markers, and CRE flows. I really dove into the credit and debt markets portion. Now they do have stuff on the macroeconomy, and I really like their comments. It's like, yeah, we've pushed back the recession a few times, haven't we? Like, yeah, I kind of agree.
Groundhog Day since 2019.
Yeah, exactly. And you know that they do say we're not quite there yet on inflation. There's some stickier parts of it, but consumer and labor markets show strength. And I do think that this is a really useful reminder. The correction in CRE started mid-2022. This is not the first inning. A rebound, they say a rebound's not far off. And, they finally kind of emphasize that the best time to buy property is when the Fed starts to cut rates. This tends to coincide with a bottoming and inflection in property values.
Yeah.
So we could be on the way up, and this is a lot more positive than some of the more pessimistic reports from CBRE last week and Fannie Mae, which is famously pessimistic.
Yeah.
But diving into the credit and debt markets, they say that credit will be tight through the end of 2023. They said pencil in gradual thawing in H1 2024. And also, and importantly, they have a whole section dedicated to alternative credit and financing that's going to kind of rise up to fill the void left by the bank's kind of more credit tight situation there. And all of these alternatives, whether it's mezzanine debt, preferred equity, senior debt, they're not going to be able to plug the gap perfectly. But it is very interesting to see, and they have a graph there that show people investing a whole lot more into the combined category of debt, distressed, and opportunistic. However, of these three, opportunistic takes the lion's share, and people who are looking for these vague opportunities. And then debt is the second biggest, and it's a sliver really of people that are looking for distressed as kind of at the exclusion to all else. Seems like it's this catch-all opportunistic.
Yeah, because everyone wants to be opportunistic. No one likes the idea of distress.
Yeah,
even true. Distress is where you can find the opportunity.
Anxiety and opportunity.
It seems because like an opportunistic, strategy could easily be focusing on distress.
Oh, that's what I was thinking. Like, what kind of opportunity? Yeah.
So I don't like those. I don't really like I don't like opportunistic and distress as like the categories.
I agree. Well, but we have seen this. We saw it in COVID. Yeah. Everyone's looking for opportunity. There were opportunities that came and went. That's another, and that got put like a bee in my bonnet about this idea of dry powder. And I'm continuing to ask this question. I'll have to ask a couple of experts because I was unable to just find it through research. How much of dry powder stays dry? How much circulation into and out of that category of dry powder is there? Or what it looks like, and I'm sure it's not the answer, it looks like these people are waiting for this opportunity to come, and it never quite does. But
I think it's coming.
If you have a better target, if you have a specific target, you're not looking for just like a big, great thing to happen next year.
Are there inflows now? Is it is it revolving? Is there, or you're saying, is it piled up and truly on the sidelines?
Yeah.
I think typically it is revolving, but I think there's more to actually been piled up in cash recently.
Okay. Yeah. That makes a lot more sense.
But, it'd be an interesting study of, when it's a lot of buying of treasuries, people, staying in cash and they're probably buying 3 month, 6 month T-bills.
Yeah.
When those start maturing, people just repurchasing, those treasuries. Some people have been continued to, but on those kind of those periods where they're maturing, people are having to reassess their strategy in whether to stay in cash or to allocate.
Okay.
And I'm hearing more conversation, people moving away from cash now, saying like, look, get the 5% is great right now, but it's not going to be there forever. I need to start looking for other solutions.
Okay.
Long-term places to put the money because, in a year from now, maybe it's only going to be paying 3%, and maybe all the good opportunities have passed by that point in time. So people are looking to, deploy. But to your question, I think there has been more actually just sitting in cash, not circulating than in previous cycles.
Well, okay. That makes a little sense. And they also did talk about that as well in the context of these alternative financing sources and how what did it say? The issue here, if you scroll back, it's like in a footnote, it says the issue now becomes how many deals, business plans, etc., can stomach a largely floating rate index plus a spread that equals 2 and 8% plus coupon. Yeah, so it's not a whole big people will come up to meet the need for debt, but it's not like a bang on.
And that's what we've been saying. It's like, yeah, there's a lot of like money that could be deployed. There's a lot of potential energy out there,
Yeah.
but there's it's not just money for any deal.
Yeah.
They have to be good deals. They have to, have an appropriate premium on the risk. And, there's, a real risk-free rate now that we have.
Yeah.
And so I think investors, whether they're aware of that concept or not, are aware that they need to be paid a little more money than they have been.
Yeah.
And paying 8% interest doesn't make it easier to do on the deal side, because people are saying, well, I'd rather be making, how do I get that 8%?
Yeah.
Like, I'll just take that instead of the 12 with a question mark on it.
Yeah.
Maybe 12.
Yeah. Now, looming over this whole conversation and really kind of motivating all of this is the looming debt maturities. And it's something that you have commented on, and they talk about this specifically on, I think it's like page 41 of the report. They say that there are multiple factors that are going to lead to a property being distressed. They pull out these 4 major factors: the diminution of underlying value, deteriorating cash flows, and this combined group of floating rate loans, bridge loans, oncoming loan maturities, and then finally constrained lending conditions. Now, we need to make a note of the visual here.
Yeah, I was gonna say, I was like, you said 4, but there's a Venn diagram with 3 circles and then a line out the side.
So I don't know. So there are the 3 circles, the line out to the side. I don't know. So 3 circles are diminution of underlying value, lower cash flows, and floating rate loans. Those are the 3. Off to the side is constrained lending conditions.
So the Venn diagram is more like internal factors to the deal, and the constrained loaning conditions are like external factors.
I think that's what it is. So each of those circles, and then the environment. That's the whole.
Can you think of it? I'm thinking of like a better way that this could have been visualized, like they could have had like a square. When they had the Venn diagrams, and then they had like a square with like use the area around the square as the.
So I have an even hotter take.
Okay.
So it's a glide.
How you would design.
Yeah, exactly. This is what I was doing all this morning.
Perfect. A lot of good work.
It's along the lines.
July.
Yeah, that's right. This is a glide path report, and why not make this kind of a linear path? It starts with deteriorating values, and then we go to, deteriorating cash flows. It starts with deteriorating cash flows, and then you get to diminution of underlying value, and then you go into your deadline of floating rate loans and bridge loans.
But does the floating rate loan bring upon the diminution?
It's
a combination of the interest rate. Yeah. Anywhere in this report, Matt, so it's called the glide path report. Is there any good analogies, metaphors, visuals related to glide paths?
I do think on the actual the tab, not the report itself necessarily.
The tab,
they have a summary website for the report. If you scroll up, they have like a little visualization that shows like this timeline. And then it is worth noting here that one of their timelines concerns the length of time in which CRE and loan maturities will remain an issue, and they say it's about the next 7 years. We're going to be making decisions.
I believe that. Yeah, I believe that. I still don't see the glide path visualization that I'd like to see.
Well, there's a little bit of a glide, like as it fades into and out of each event on this timeline. I'm giving them the benefit of the doubt. I really did.
It's like a Gantt chart, and that was what this is.
I'm not up to speed on on nomenclature for I know line graph. I know
glide. It's not glide.
And bar. Those are like the 3. Oh, scatter plot.
Scatter plot's good.
Yeah.
Anyway, that's why you come here for the information, but you stay for the critique on the visualization of the report.
And they had multiple takeaways that we have kind of repeated here. One, when it comes to loan maturities, is one, it's not going to be uniform. It's not going to infect the whole market necessarily. Pockets of distress. And they repeat the greater demand for alternative forms of financing. The 7-year, the kind of 7-year span of time, and ultimately they say that, and you're gonna have to parse this for me. They say that significant opportunity exists to optimize stressed and distressed assets and portfolios in response to changing market conditions. This applies to multiple points within an asset portfolio lifecycle, all as it applies to both asset management and capital debt market opportunities. Get out.
So what does that mean?
I think it says, get out there. Let's start trading.
Yeah, it does mean get out there, and sometimes these assets need to be recapitalized, and I think that's partially what they're going for, is that it needs a new little life cycle, need a new fresh blood and fresh energy. And a lot of times, what happens is an owner goes into these deals and they've got all these great plans, and they do the plan, but they bring in enough money to do the big thing. If typically it's a value add or something, we're gonna fix some things up. So you bring on the money to fix it up, then you spend that money. And then you're setting aside money for CapEx, but it's more of like maintaining. You're not necessarily bringing on like a lot of money to like renovate the whole property. You usually have to bring on funding, whether through debt or equity, to do that. And there's a lot of assets that like, it's a good deal, but it needs another $1 million. Yeah. These guys are out of cash, and they're barely making any money right now. But like this thing could be great, but it needs an injection. And so I think that's what they're getting at, is that there's going to be different opportunities for different assets in their life cycle. It could be a developer is just delivering a new development, but they thought they were paying 3 to 4% on their interest rate for their construction loan. Now they're paying 8%, and so they've gone through all their cash, and they just need to sell it. And maybe that they've leased it up at lower rents because there was low demand for a certain period. And so then there's a new owner just needs to come in and just operate it in different context.
Yes, cut it loose. I think that there is
a lot of cutting loose.
There needs, you can't reel it in. You just have to save your future money that you would have spent on it. And I wonder if that's what it is. It's like, listen, if you're looking at this distressed deadline that's coming up, stop pretending you're going to save money in the long run. If you come to this realization sooner than later.
Yeah, I was going to say sooner rather than later, because they're not putting their best effort to it.
Yeah.
Just quick story. So I was good about 30 miles or so off the coast of Key West. So 60 miles away from Cuba, and we were fishing. And I hooked up this big fish, and it was fighting for about 25 minutes. I'm getting tired, but I'm like, I'm fighting. I'm like, this thing's coming on the boat.
Yeah.
This is what I'm out here for. And get a little closer, start seeing some color. And long story short, it's this big shark, big lump shark, which is cool. But if you've done enough fishing, you've caught enough sharks, and like it's cool to catch a big shark. It's a big fight, but you're not eating the shark, and you gotta have to deal with unhooking it, and it's a little bit of it can be a thing, but it's still fun. But I see the shark, and it's like, it's not something I'm going to bring home and eat. Not something I'm going to bring on the boat.
Yeah.
And I'm like, sooner to get this thing off the line, probably the better.
Yeah.
And I all of a sudden am not as motivated in this fight. I mean, I'm still having fun.
Yeah.
But I care just a little bit less.
Yep.
Because I need to get it off. And then a couple of minutes later, it kind of swims, it's getting much closer. It swims under the boat. Basically, probably 10 feet away from, landing it.
Yeah.
It goes into the boat, and the line snaps. Perfect.
There you go. All right. Yeah. Yeah.
So I was very tired. I'm happy to be done.
Yeah. Yeah.
And I think these owners it's the same thing. It's like, it isn't going anywhere.
Yeah.
Like there's no meat. There's no dinner we're bringing home. Sooner the better.
Yeah. Changing plans. And, maybe don't talk about it like a failure. Just say, listen, plans are changed.
Excited for the new owners.
That's right.
Great property.